Hello everyone, Stewart Heath here, founder and CEO of Harvard Grace Capital, back with another episode of our series on why you should consider real estate. And really we're just of the opinion that real estate should become a significant part of everybody's investment portfolio. And so we're comparing real estate each week to a different asset class. And today we're going to talk about bonds. When you say bonds, there's all kinds of bonds. There's U.S. Treasury bonds, there's corporate bonds, there's tax-free bonds issued by municipalities, there's even junk bonds, which are, about what they sound like they are. There's a time and a purpose for each one of these, but as far as long-term positions in bonds, we feel like you should look at some real estate as opposed to that. So what are some of the advantages of bonds? Well, let's just stick with the U.S. Treasury. So they're very secure. It's the most secure asset class in the world by definition. They can be a little volatile, but no doubt depending on whether or not you hold your bond to maturity, you're going to get your money, and you're going to get whatever the stated face amount of interest rate that they're paying you. I tend to follow the 10-year bond, every day, sometimes multiple times a day, because that's what drives lending rates for the commercial real estate that we're involved in. If you're doing bonds for less than, just say, the term of the bond that you're buying, then you're now into the volatility of that market. As interest rates move up and down, the yield on the bond, which is your real interest rate, moves up and down too, and the yield determines the value. So if your yield goes, let's just say you bought a bond for $100,000 at 4%, but if the yield goes down, you can't get out of that bond for $100,000 anymore because the yield's not there. You've got to hold it to maturity to get all of that money back. Alternatively, if the yield goes up, you can make what's called a premium in addition to the rate. Now, there's a time and a place for bonds, but if you're considering long-term investments, we really think you should look at real estate. Bonds are, by their very nature, not inflation hedges, unless there's some sort of a variable bond, and you don't find those very often. So they're not inflation hedges. There's absolutely no upside to them. It's potential downside if you exit early. There's no tax advantages to them. All of which you get with real estate. You get tax efficiency, you get an inflation hedge, and about the only thing you don't get with real estate is liquidity, instant liquidity. But you can solve that with a little bit more time because it's so leverageable. You can borrow against your real estate and pull cash out as you need it. So those are our thoughts on real estate versus bonds. Would love to hear you. Let's have a conversation. Thanks for watching. I hope this is helpful.